दो आप लोगों को लगे कि फाइनेंशियल मैनेजमेंट काफ़ी वास्ट सब्जेक्ट है, काफ़ी मुश्किल है, अगर आप लोगों के बेसिक्स क्लियर होंगे अच्छे से, इफ़ यू नो व्हाट इज़ अ पर्टिकुलर फॉर्मूला, आपको पता होगा उसका बेसिक थ्योरी पार्ट, तो फिर आप उसको अप्लाई भी कर पाएंगे। तो पहले हमें कॉन्सेप्ट क्लियर होना चाहिए। कॉन्सेप्ट अगर क्लियर होगा हमारे को, तो हम हमेशा उसका एप्लीकेशन बहुत आसानी से कर सकते हैं। ठीक है, तो चाहे प्रैक्टिकल प्रॉब्लम्स हों या कुछ भी, अगर हमारे को पता है कि कंसेप्ट क्या है, अगर हम कॉन्सेप्ट अच्छे से समझ सकते हैं, तो हमको उसके कितने भी मुश्किल क्वेश्चंस हो जाएं, उसको भी सॉल्व करना बहुत आसान होगा। नाउ आई थिंक काफ़ी स्टूडेंट्स आ चुके हैं, सो नाउ वी विल कवर। तो आप लोगों को याद होगा इनकम रेशियोज में हमने कल जो पढ़ा था, जस्ट अ सेकंड, so see, in the very first session we had studied the overview and basics of this. We always take this example, okay, and just so in the very first session we had taken this example, okay, wherein we have the capital structure of the firm, जहाँ पर equity share capital में there is 100 lakh rupees, reserve and surplus में 50 lakh, okay, preference share capital, and preference share capital may it's a fixed return kind of a investment, so you get 12%, the owners get 12% dividend on the amount of income that they have, on the amount of fund that they have provided, okay. Then there is borrowings, or you call this long term debt, okay, which is debentures and term loan. Again, you provide a fixed interest on these, all right. And then we had taken the different examples, like which fund is called what. This is your net worth or equity, okay. After this we had studied the different capital structure ratios, like what is equity ratio, debt ratio, debt to equity, debt to total assets, capital gearing ratio, proprietary ratio. All right, these were the different capital structure ratios. I'm just very quickly revising this so that you all can be on the same page, okay. Then we had discussed the concept of income statement, okay. Based on the same firm, let's say that the sales of this firm was 2000 lakh rupees. In order to get the gross profit, you subtract the cost of goods sold, okay, which can be determined by opening stock plus purchase minus closing stock, and if there are any wages or factory expenses. If these values are not given, in that case this is enough, okay. So you got gross profit. From gross profit you subtract the expenses, okay, and after this you get the EBIT or operating income. Now this is earning before interest and tax, all right. So you will subtract interest in one go to get profit before tax or earning before tax, okay. And then if you subtract tax from here, okay, let's take that we had taken 40% tax, okay, so then you will get net profit or the profit after tax. Now this profit is the starting point for appropriation of profit, for providing what amount we need to provide to our owners. So right from the net profit, first of all we subtract the preference dividend, because this has to be provided. As I said, this is a fixed return kind of a fund, okay. So whatever is left is the earnings available to equity shareholders, all right, and they can decide to either divide this completely as the dividend, equity dividend, or they can say that okay, my business needs some amount of this, So I will keep this in the retained earnings as reserve and surplus for my company. Okay. And the rest, whatever amount is left, they divide among themselves as equity dividend. Okay. Now, based on this concept, we had then done these profitability ratios, expense ratios, and then the return ratios. Okay. So till this point, is everyone clear? You can write to me on chat. Okay. So I'm assuming everyone is clear till now. Clear. Perfect. So now we will continue from where we left yesterday. Okay. And that would be the stock ratios. So your capital employed, alright, or a numerator, their value. It ratios. Now these ratios have to do, with the per share value. And this share value is of three kinds. Okay. First of all, it is the face value. Now, what is face value? This is the value at which, the shares were first, allotted. Okay. The second one is your market price, market value or market price. Okay. You can also call it current market price. And this is the value at which the shares are currently being sold and bought in the stock market. All right. The third one is, and this book value, you have already studied that this is calculated based on the assets of the company, and you evaluate that based on the net worth of the company, how much should be the actual value of the per share. All right. So coming to the first ratio, the very first ratio is earnings per share. All right. Now, what does this mean? This means that for the equity shareholders, what will be the earnings, available based on the divided by the total number of equity shares. All right. So you remember that in our appropriation of profits also we had studied that earnings available to equity shareholders. You first take your net profit, right? And once you subtract the preference dividend from it, the amount that you are left with is the earnings available to equity shareholder. Therefore, this ratio can also be written as PAT minus preference dividend divided by number of equity shares. Okay. So in the previous example that we had taken, it was 149 lakh was the PAT. Okay. And 6 lakh was the preference dividend. Therefore, 143 lakhs. Okay. Divided by number of equity shares. Now, number of equity shares. So remember that the equity capital in the example, right, was 100 lakh rupees. Okay. Now, assuming that the face value of these shares is rupees 10. Okay. Therefore, number of equity shares would be 10 lakh. Okay. So therefore, 14.3 is the value of earnings per share. What does this mean? That for each share of the company, that the equity shareholders have, they have earned rupees 14.3. Okay. Next is dividend per share. And in this, you calculate the total equity dividend, all right, divided by the number of equity shares. Okay. Further, in our example, we had calculated that the equity dividend, that after 143 lakh rupees, we had taken 40% in our retained earnings, and therefore the equity dividend that was left was 86 lakh rupees. Okay, and the number of equity shares 10 lakh, therefore 8.6 is the dividend per share. Next one is dividend payout ratio. So basically, what is the dividend per earning? All right. So how you calculate this is dividend per share divided by earnings per share into 100. So this was 14.3. This was 8.6. So therefore, 8.6 upon 14.3 into 100 will give you the value of dividend payout ratio, which comes down to be, which comes down to 60%. Now there's one thing which is noteworthy here. You remember that in appropriation of profits, we had taken that 40% of the overall, the dividend of the earnings available to equity shareholders, we had taken as retained earnings, right? Which means that 60% of the earnings available were the equity dividend, right? And this is the same as your dividend payout ratio. Okay. So basically, what is the payout of the dividend, right? Which is the equity dividend. So if you are from the total earnings available to the equity shareholders, if you are taking 40% as the retained earnings or in the reserve and surplus, so 60% is left, and therefore this is your dividend payout ratio. All right, and 8.6 by 14.3, or you can also take this formula, and this will give you the value. Now by this, the other thing which is naturally which comes down, what is the retention ratio? All right, and the retention ratio will obviously be 40%, the amount that you are retaining in the company from the earnings available. All right, and this can be calculated by subtracting the dividend payout ratio, all right, from 100. So 100 minus 60 will give you 40%, which was the retained earnings. All right. Now the next one is price earning ratio. As the name suggests, you have to take the price, and this ratio is between the price and the earnings. All right. So what is this price? This price is your current market price. Okay. This price is the current market price at which the trading is being held in the stock market. All right. Let's assume that this is 200 rupees. All right. And this has to be divided by the earning. Here, what we mean by earnings is the earning per share. All right. And the earning per share is 14.3. So you divide this by 14.3, the value comes around 14. So what does this mean? This means that the current market price is 14 times of the earning per share. All right. That the market price is 14 times the earning per share. All right. Now the next one is dividend yield ratio. Now dividend yield ratio, basically how much of the dividend will be yielded, or how much dividend you will get. All right, at the current market price. So how you calculate this is by dividing the dividend per share value by the current market price. So 8.6 8.6 by 200 into 100. Therefore, you get 4.3%. Now, what does this mean? See, in the current scenario, when you invest 200 rupees, you're getting a dividend of 8.6 rupees. Okay. So, this means that the return that you're getting in the form of dividend is at 4.3%. Okay. So, therefore, if you invest, in let's say 1 lakh shares. Okay. So, the dividend that you will get is at 4.3%. Okay, and therefore the amount that you will get is 4300 rupees in the form of dividend if you buy the 1 lakh shares at 200, the market price of 200 rupees. Now the next one is earnings yield rate. And here what we have to calculate is what is the total earning per share. Alright, regardless of whether what amount is going into dividend or what is the retained earnings. Alright, regardless of that, what is the final, how much will I earn? Okay, what is the final payout per share? So this is calculated by dividing the earning per share, that was 14.3, by the current market price. Alright, so you get 7.15. Alright, what does this mean? This means that at the current market price, the earnings that you are getting is at 7.15%, which brings us to the very last stock market ratio, which is market value to book value ratio. The name itself suggested, you divide the market value, which is the market price per share, by the book value ratio. So let's say that in this example the book value stood at 50 rupees. What does this mean? This means that the trading of the shares is going on at 4 times the the theoretical book value. Alright, that the share is being sold and traded at 4 times the value of what has been calculated based on the assets and the net worth. Alright, so these were the with this we complete the different ratios. Alright, the different stock market ratios we'll quickly revise. The very first one is earnings per share, alright, in which you calculate the earnings available to the equity shareholders divided by the number of equity shares. Alright, and as you know, earnings available to equity shareholder is also net profit or PAT minus the preference dividend. The second one is dividend per share, and in this you calculate by dividing the total equity dividend. Alright, this is the equity dividend which is paid out after first you give the preference dividend from the PAT. Alright, and then once you have taken whatever the retained earnings are there, alright, so PAT minus preference dividend, and then you remove the retained earnings, then you will get the total equity dividend. Alright, and then you divide this by total number of equity shares. That will give you your dividend per share. In our previous example, earnings per share, this amount was 143 lakh rupees. Alright, this was 10 lakh, assuming the face value of 10 rupees. Alright, so this earnings per share was 14.3. Okay, your dividend per share, because total equity dividend was 86 lakh rupees, so dividend per share stood at 8.6. Okay, then we calculated dividend payout ratio, which is your dividend per share divided by earnings per share. So therefore 8.6 upon 14.3 into 100, which is 60%. And you also know that this is also the amount that you are basically dividing giving to the equity shareholders in the form of equity dividend, which was 60% because 40% of the total earnings, earnings available to the equity shareholders, we had taken as retained earnings. All right, so therefore it is also 60%. Okay, and because from the total earnings available to the equity shareholders, you either keep some in the retained earnings or you give them in the form of equity dividend. Therefore, if you have to calculate the retention payout or the retention ratio, in that case it will be 100 minus the dividend payout ratio. So therefore 100 minus 60, which is equal to 40%. Next one is price earning ratio, and this is very simple, in which you calculate the price divided by the earnings, which is your current market price divided by earning per share. Okay, so in the example we have taken that the current market price is at 200 rupees, the book value is at 50 rupees, and the face value was at rupees 10. Okay, so therefore current market price by earnings per share, that is 14.3, 14. Therefore this means that the current market price of the shares is 14.3, 14 times the earning per share. Next one is dividend yield ratio. So basically if you invest in the shares of this organization today, what is the percentage of dividend that you are getting? And therefore this is calculated by dividing the dividend per share value by the current market price, okay, which is your 8.6 by 200 into 100, therefore 4.3%. Okay. The next one is earnings yield ratio, that regardless of the form of the what I'm earning, whether it is in the form of dividend or in the total equity amount, okay, whatever I'm getting, but if I invest in this share, so here the value is earnings per share, that is 14.3 divided by 200, which is 7.12%. That means I will get a return of 7.12%. All right. And finally, market value to book value ratio, which means 200 upon 50, which means 4 times. Therefore, the share of this company is being traded at 4 times the calculated book value. All right. So that was it about the stock market ratios. Okay. Next, we will start with the coverage ratios. But before that, I want to know if there is any question so far in the ratios that you have studied. You can let me know on the chat. Everything is clear. Okay. All right. So without any delay, let us study the coverage ratios, because we have to quickly cover the liquidity ratios, the turnover ratios, before we move on to the practical problems. All right. We will, by in the next 3 or 4 sessions, in the next third session, I think we will be covering practical problem, covering all the ratios. All right. And that will help you apply these concepts which you are studying now. So, all right, I will also share, the WhatsApp groups of SuperProfs which are there for CA Inter and CMA Inter on chat itself. You can join them, and there's already a link for Telegram. So you can also join that channel to receive updates. Usually the session for financial management is held every day at the same time, that is 6:30 p.m. Okay, but just in case, because they have other sessions for CA Inter, for CMA Inter, for CS executive exams also, so you can receive all the updates on these channels and groups.
Alright, so now the third kind of ratios in P&L, which is coverage ratios. Now what does this mean, coverage ratio? Well, these are the ratios, which, when you calculate them, they determine the capacity of the organization to repay its obligations. Okay, what do you mean by, what are these obligations? So you remember that in when we were studying income statement, then we had discussed that, you have to pay from an organization, you have to pay the interest to the borrowers, right? Like there is a bank or any kind of preference share capital also you have to give the interest, from appropriation of profits. Okay, whatever tax you owe to the government, all right, and in interest also you can give to a bank or any other kind of loan or financial institution, right? So all these things, which warranty and interest, any kind of debt, okay, all these are your liabilities or are your obligations. So from an organization point of view, how much capable you are to pay these, whether they are interest or taxes or any kind of preference dividend, any kind of equity dividend also. Because even though it is the owner's money, but from the organization you have to pay that equity dividend, right? So all these, obligations, all these liabilities that the organization has to pay to the different stakeholders, whether they're borrowers or the equity owners itself, right? This is covered in your coverage ratios, right? For example, let's say that you have to pay this interest, okay, of 51 lakh rupees, and this needs to be paid from what? From your operating income, okay, from your EBIT, that is earnings before interest and tax, because then you will subtract the interest from here. And therefore if your EBIT is 300 lakh rupees, okay, and you have to pay just 51 lakh rupees, that means you have surplus of the earnings from which you have to subtract this interest, okay. However, let's say, so the company is in a good position, it has a good capacity to pay the interest obligation. However, if the interest, let's say, take an example in which the interest was, let's say, 100 lakh rupees, they had taken a lot of borrowings, okay, and the earnings were just, let's say, 120 lakh. In that case, this was a very close call, okay. Or after this earnings, there was very less room to pay any other kind of obligations, right? Because the difference is only 20 lakh rupees. So in this case, there's not a very high room, or there's not very high, very much big gap to pay this, okay. Whereas in the current example that we have taken, when you have to pay only 51 lakh as interest from 300 lakh rupees of EBIT, that is the operating income, in that case you are in a very good position, right? Why? Because 300 upon 51 lakh, it is almost 6 times, okay. And therefore, because you have around 6 times the money that you have to pay, so your organization is in a good position to give this interest debt, all right. So therefore, how we write this is interest coverage ratio, because you have to pay the interest from the earning before interest and tax. So the interest coverage ratio becomes EBIT upon interest, which is equal to 300 lakh upon 51 lakh, which is approximately equal to 5.9, or you can say 6 times. Okay, I hope this is clear. Now, going on similar lines, the second kind of ratio that you have is your debt service coverage ratio, okay. And in this, now see, debt also you have to pay from the earning before interest and tax only, okay. So you have one liability of interest, and the other liability is your installment. If you have to pay any kind of installment to your borrowers. So the next one is debt service coverage ratio equals to EBIT, because you have to pay this also from the earning before interest and tax only, divided by your interest along with the installment if you have any. Now this installment, this is actually the principal amount. All right, the principal amount that you may have to pay, okay, against the loans that you have taken. All right, so you already have, interest of 51 lakh rupees. Let's say that the installment you have to pay is for 49 lakh rupees. Therefore, your liability, your debt service coverage ratio will be 300 divided by 100, which is 3 times. All right. So the organization is in a good position to pay the complete debt, all right, which includes the interest as well as the installment, because it has 3 times the money that it has to pay against this debt. All right. The higher the coverage ratio, all right, like you see here, it was 6 times. All right, here it is 3 times. The higher the coverage ratio, the better position the company is in. All right, because that means that you have a lot of extra profit from which you can pay your liabilities, whether they are any interest, any debt, or even the preference dividend. All right, now remember our discussion about appropriation of profits. We had determined that preference dividend of rupees 6 lakh needs to be paid right from the net profit. Okay, now the net profit is 149 lakh rupees. Okay, and from this you have to pay only 6 lakh rupees. All right, now this is again a very good position, because this is a very easy situation wherein I can pay just 6 lakh rupees from 149 lakh rupees of net profit. So this gives you preference dividend coverage ratio, which is calculated by dividing the PAT, okay, the profit after tax, or the net profit, okay, by preference dividend. Okay, so 149 lakh divided by 6 lakh, which is approximately 25 times. So again, a very good position. Okay. As I said, the higher the coverage ratio, the better the position in which the company is. And the last one is the last obligation that you have to pay, that is the equity dividend. All right. Now equity dividend again has to be paid, once you have calculated the earnings available to the equity shareholders, okay, which is calculated how? By net profit or PAT minus your preference dividend. Okay, this is equal to earnings available to equity shareholders. Okay, and from this you have to pay equity dividend. Right, so this goes in the numerator. Your equity dividend was 86 lakh rupees. Your earnings available to equity shareholders is 143 lakh rupees, approximately 1.67 times you get. All right, because this is the last liability. So again, you are in a very you are in a decent position, because even after paying the equity dividend, you still have, some amount left with yourself. So overall, this is how you calculate the different coverage ratios. You can also write this as PAT minus preference dividend upon equity dividend. These are the various coverage ratios that we had to study. Now note that there are different ways in which you can calculate. Some people interest calculate tax also in the interest coverage, take into account the tax also. But all these formula, there are different ways. This is also correct. All right. So next we will study the turnover ratios. Okay, so a lot of students here. Are there any queries? I hope all the concepts which have been taught so far are clear to you all. if you feel that I'm going too slow or too fast, you can also let me know, and I will try to incorporate your feedback in the session. Okay. Now, if that is all, I would like to wind up the session today. I have already shared the Telegram and WhatsApp group links. You can join these channels and groups, because that is where you will get a lot of free resources in terms of videos, helpful videos, and uh, this final group. Yes, we also have final group. Dipali, which exam are you appearing for? No, which exam? CA final or CMA final? Okay, let me just give me a minute so that I can get that link. All right. Are there any queries that any of you are facing apart from this ratio analysis also in financial management? No queries. All right. Dipali, if you will join the Telegram channel, no, we'll share the group link there. I think I don't have the WhatsApp link for CMA final right now. All right. So this course for financial management is available in 100% English, like the way I have discussed so far, and it is also available in Hindi English mixed language. There are two different courses on SuperProfs. All right, you can contact them regarding the fees or procedure to join. Okay, classes will be for only FM in this series. That at 6:30 p.m. Yes, these classes are for FM ratio analysis only. But apart from this, also there are a lot of free sessions going on. All right, and those include cost accounting and other, I think, tax law. Everything is there. So see, tomorrow is Friday. So for Inter, we have Ashish Dulasi sir's taxation class. Okay, and for final CMA final also, we have 7:30 to 8 p.m. session tomorrow, which is for CFR. All right. So just if you follow this channel closely, the Telegram one, all the updates regarding which session is when is there. Otherwise, also you can join at 5:30 p.m., 6:30 p.m., or 7:30 p.m. There are all these sessions. Okay. Uh, Vardarajan is saying, I want class for October month for forthcoming November exam. Sure, Vardarajan Hemamali, what you can do is just call 011 or you can send, in two, you can just select my name personally and send me your number, and I will arrange for a call back from one of the counselors who can help you with the same. Okay. Yes, all the handouts, including these PDF, this presentation notes, are included in the financial management course. So I include both the way I teach as well as the PDF notes that I have provided. Already they are available in my course. All right, today also we have a session for CMA final and CA final, that is applicable for law. Okay, and that is a very important session on answer writing in the examination. All right, that is being held by CS Priyanka Srivastav ma'am. It is also in English, so another very helpful session. Okay, and you guys can send us your feedback. If you like the session or you don't like the session, you can just write on chat so that I can also know that if you are engaged enough and attentive enough. All right. So if there is any other query, you can ask me right now. I'm here for another few minutes. All right. So I think that is all. You are not asking any other queries, not providing any feedback. So, all right. Thank you, Ananya. Thank you, Archana. Thank you for being attentive. Okay. The more you are attentive in these sessions, the more beneficial it is for you. It's a very good thing that SuperProfs is conducting this series so that you can stay at home and study online. Right. It's better to have a proper guidance in the form of online classes rather than just worrying about whether to give the exam, appear for the exam or not, and from what all resources I should study, right? So you should definitely utilize self study resources, but if you have proper guidance, it is going to save you a lot of time, and trust me, a lot of attempts also. Okay. For those of you who are not aware, I am also the CEO of SuperProfs. I have done my MBA in finance and marketing as the dual specialization, and in operations as the minor. All right. And Shruti Anu is asking, see, notes will be provided if you enroll for the the course of the financial management course. Then notes will be provided in the platform itself. They are there. Okay, Shruti. All right. Mm, okay, then this video will also be available on YouTube and Facebook. So in case you want to revise, you can log on there and check the recording. Thank you and have a nice day. All the best for your exams.